Hi everyone, today we'll be talking about some common insurance terms. This is Objective 2 in the unit. I want you to be able to explain the terms insurance policy, insurance premium, insurance claim, deductible, coverage limit, and out-of-pocket costs. Let's dive right in. An insurance policy is a document or an agreement between you and the insurance company. It will detail exactly what the insurance company is agreeing to help you pay for, the limits that they'll have, and things that they won't cover or conditions where they won't honor their policy. An insurance premium, this is the amount of money that you pay each month for your insurance. So it's like your insurance bill each month. We call that a premium and not a bill. Premium in this case, note that it's a common English word that means like really nice stuff. It does not mean that in insurance. In insurance, all it means is it's the monthly payment you make for your insurance. So if you get a letter in the mail stating that your insurance premiums are increasing for the next chunk of your next year, that means you're going to be paying more each month for insurance. Not that you're getting more, you're just paying more for it. Okay? An insurance claim. This is when something happens that's covered by your insurance policy, and you're going to basically tell the insurance company this thing happened. So if in the case of an auto insurance, you're going to say, hey, I was in an accident. Either I hit someone or they hit me or we were both kind of at fault. And doing that is called filing a claim. And the claim is the request for the insurance company to get involved and help pay their portion of the accident, to help you, actually I shouldn't say their portion, help you pay for the accident. Yeah, for your portion of the accident, not theirs. You own the responsibility, not the insurance company. Okay. And this is called filing a claim. Insurance deductible. So this is a little bit confusing. We'll get more comfortable over time, but this is an amount of money that you agree to pay when you file a claim. It's basically, you're saying, I'm going to pay this much up front, and that's called the insurance deductible. Typically, you need to, or insurance deductibles range anywhere between $0, so no deductible, up to about $2,000 would be a high deductible. If you choose on your policy to have a $2,000 deductible, this means that before the insurance company will pay their portion, you need to pay $2,000 to the insurance company as your deductible, basically offsetting the losses of the insurance company. Now, the higher your deductible, the lower your monthly payments for insurance. Your insurance is cheaper. Your insurance premiums are less. Okay? All right. As a result, your emergency savings need to have at least enough money in it to cover your deductible. Because if you get into a car accident, you've got to come up with that money quick, fast, and in a hurry so that the insurance company will start kicking in their part of the payments. Coverage limit. So we've already talked about this a little bit, but I wanted to put it in here formally. So a coverage limit is the maximum amount that an insurance company will pay for a particular type of coverage. So if it's bodily injury liability, the total max is $50,000, and there's another coverage limit of $25,000 per person. So in that case, there's two coverage limits, a total and a per person limit. And that total limit is actually per accident. So it's all just like really complicated, but we'll get there. Anything in excess of the coverage limit, you're still responsible for. Remember, the insurance company is not responsible for paying for the accident. You're responsible for it, and the insurance company is helping you pay for what you're responsible for, but the responsibility lies with you, not the insurance company. Okay. And each type of coverage will have its own limit. There's no such thing as like fully covered or unlimited coverage. There will always be a dollar amount. It might be a huge dollar amount. You might say, hey, I want $1 million of bodily injury liability coverage. The insurance company will say, sure, that's great, but they're going to charge you a lot of money every month to have that coverage because now they're risking a lot of money on an accident you have. And here the property damage liability coverage is $10,000. That would be the coverage limit, that $10,000. Out-of-pocket costs. We've already covered this as well, but I want to kind of get it formally into your notes. This just refers to the amount of money that you have to pay above and beyond the insurance. So once you've maxed out your insurance policy, we've hit a limit of some kind, then the rest of the money that has to be paid for the accident is yours to pay. I want to really reinforce this idea. Some people have the wrong idea that once you have insurance, that your insurance company is required to pay for an accident. They're only helping you. You're the one that's required to pay for the accident when you're at fault. So they're helping you pay part of that, or perhaps all of it. But the rest that's beyond what they pay is out-of-pocket cost. You're still responsible for it. Okay. And here's an example for you. $15,000 in property damage. You have minimal liability insurance. You hit the limit of $10,000. The remaining $5,000 would be called out-of-pocket cost. Great job today. Hope that was helpful.